Mike, you had written to investors and outlined a trade on ARK to the downside, captured it, and looks like you took profit. You're waiting. Walk me through how you think about it now.
Yeah, I think you have to respect the overall broader trends in this equity market that are very, very strong. When I put the trade out there at the end of January, I was kind of struggling to find a sort of a risk-off type of hedge in a world where implied volatilities on typical risk-off hedges like SPY puts was really expensive. And so I was thinking about it, and I knew ARK, it's not a judgment at all about the portfolio manager or about the investments per se. What it really was a simple judgment about the market structure inherent in that ETF, where they just had so many flows coming in, and there was a lot of allocation into some large cap names, but also some smaller names. And if they were vulnerable to flows, which inevitably they would be, there was what I would call a lot of sort of internal gamma just in the ETF itself. So I was a bit early on that, but it did ultimately roll over the way I expected to. I think one thing I think it's important for your viewers, Oliver, to maybe also one thing this exercise reminded me of is that I was in a put spread format, and when the put spread worked against me in the first couple of weeks of the trade, this short put I was able to buy back at a very low cost, and then when it did roll over, the long, I was just there with a long put. So I actually made money on both legs there, but particularly from that short put. So it's a good lesson or a good reminder that managing option positions is through the trade is really important.
I like that point.
Yeah, so I took profits, on that big move we had down last week on the there, and it was, I just thought it had completed, a pretty massive turnaround. I had to respect the broader currents in the markets that have been so supportive of equities, and particularly for some of these very high growth names that ARK has been investing in. And so I didn't want to be, too greedy, if you will, on the, on that put spread there. If we get, a real strong rally in ARKK again, combined with a lot of very strong inflows into it, I may well look at going back in for another put spread there, because I do think that it is, when you start seeing outflows, it will magnify the downside performance, and not just of the ETF, but also of the stocks that it's in. So you have to be very careful, even if you're not invested in ARKK, you have to be careful if you have the stocks that ETF is invested in. You just have to be aware of it, particularly for the lower liquidity, smaller names.
So Mike, I guess depending on what happens next, if the market rallies back and ARK rallies back with it and that trend continues, then maybe that trade presents itself again as a way to kind of short the S&Ps by proxy. There's also the possibility that we do have some more severe rotation than we've seen in the past, and ARK can depart and the market grinds led by different companies. What do you look for as the characteristics that make that trade appealing to use ARK as a proxy, or some other kind of high beta type fund? Because I'm sure folks have been in the same boat, right? We're looking at VIX at 20. It's been fairly expensive to just try and buy volatility and hedge that way.
Yeah, sure. I mean, I think look, this is a macro condition where you have a lot of risk on boxes you can check, right? And you have a lot of flows coming in. I think people understand the broader reason to own equities in an environment where GDP growth is accelerating, but the interest rates are still, at unusually low levels there. So within that context, you need to see which parts of the equity market are the most vulnerable, right? So, when I see things that have shot up so much so fast and also have those sort of market structure type issues I was just touching on, I think those present good sort of tactical opportunities there. And if you start seeing a real change in the overall upward momentum in the broader equity complex, and sometimes those tactical trades turn into a series of bearish tactical trades there. But right now, I'm not seeing that broader pivot yet. I still think that the broader macro condition is pretty constructive for equities.
Okay, let's talk about the move from last week. Mike, let's talk bonds here. We had this big move in yield breaking upwards. I look at your notes. You don't view that as something that is likely to continue in the short term. So walk me through the way you're thinking about bonds, if there's something still tradable here, if the short bond trade is over and done. What are you looking for in this?
Well, I think, it's a complex discussion, Oliver, but, walking into last week, it was really interesting to note, if you looked at the CFTC futures positioning data, the long positioning in the 5-year Treasury futures contract, essentially a view that 5-year rates are going to go down a lot in the near future. That long positioning skyrocketed this is data released Friday afternoon, reflecting Tuesday afternoon data.
Yep.
So you can see that blue line. You can see that shooting up just into Tuesday, right? So
people got long after the yield spike?
Well, the blue So that blue data, that blue line reflects Tuesday afternoon. So before the Thursday drama, right? Right. The data is not released until Friday afternoon, but it's reflecting how people are positioned, as of Tuesday afternoon. So clearly, what I'm saying here is, last week, did you have a lot of big economic news? No. Did you have a lot of big Fed news? No. Did you have major news from other central banks? If you did, it was net dovish. So what you did have is a pretty dramatic move in positioning. So I think, first of all, when you explain, when you come up with narratives for these big moves here, you just have to take back. And sometimes things can move around a lot just because of positioning there when people are caught on the wrong side.
Hey, Mike, I just want to jump in there real quick, because there's this idea that I think you're pointing out that's really important, which is that there wasn't some revolutionary data point. We actually haven't even had any hot inflation data points yet, right? This is all about speculation that it's going to come. We are beating the data. But at the same time, isn't that kind of the point here, that this has been going on since August? Last week was a spike, but the trend has been one of the most complete, just higher highs, higher lows, textbook trends in yields since August. I mean, isn't this kind of the point that maybe this is telling us we don't need any huge developments for this trend to go one way and spurt up and down sometimes? This has been going on since August. And I like the point that there's been no huge data point last week. I mean, isn't this just positioning that goes way back beyond, for like decades?
Yeah, so Oliver, to help sort of answer that very good question, when I sort of try to deconstruct the 10-year Treasury yield, where it's really interesting is that the Eurodollars futures contracts had massive movements last week, right? And if you follow the trajectory of basically the 2000, sort of September 2022 through the end of September, through the end of 2024, and the Eurodollar futures contracts that are futures contracts on short-term rates in the future, you can see that those have been moving very dramatically since last August, right? And so what I've been talking a lot about is that every basis point of the 10-year yield can be explained by a rise in the Eurodollars futures curve during that time period. Okay. Just as an example, on Thursday, the 10-year yield went up by 14 basis points. That Eurodollars futures contract curve went up by exactly 14 basis points, right? So that's what's defining it. So what I think is important to say is that first, we don't see quote unquote like a credit premium being built into the 10-year, because we're going to have much bigger deficits respectively there. So that's not happening. It's really just about rate hike expectations. And so one of the fascinating things is that Powell has been saying, look, read my lips, through the end of 2023, we're going to keep Fed funds at zero. And now we have a Eurodollars, the rates markets are saying we're going to get 4 hikes in 2023. That is a massive gap, right? So that gap has to be resolved, right? They can't both be right. So at some point over the next 12 to 18 months, either Powell's got to cave to the markets, or the markets have got to cave to Powell, or maybe a bit of both, which is, my guess is that's the probable answer here, right? We're making some hikes and so forth there. But I think it's also important to recognize that the that because, like, if we had a big sort of term premium being layered into this 10-year Treasury above the interest rate, the rate hikes are being anticipated, that would be a real problem for equities, right? That would be a massive problem for all sorts of asset classes, but equities as well. You're not seeing that. In fact, the term premium actually slightly contracted last week, amazingly, if you measure it that way. So why is the Eurodollars curve getting so excited about this liftoff in a hiking cycle? Well, they could be right, they could be wrong, I don't know, but I do know that it's probably because growth is really good. Right. We have 7% growth, potentially 6-7% growth this year, right? And so why are equities not, falling off a cliff with this rate rise when relative valuation has been sort of the foundational argument since last spring to be bullish equities? You have to keep in mind that earnings estimates have been coming up. In fact, earnings estimates have accelerated more than bond yields have.
So
right?
growth is coming up.
Earnings
estimates are coming up. They can offset, and then at some point, we're going to have Powell meet the market in the middle, because it sounds like he's not going to cave to the market quite like he did in 18, but maybe he'll have to bend a little bit. Mike, we got to run. Really good stuff. I know we could keep going here, but I really like the point here about how that gap's got to get filled, right? As there are some degree of hikes getting priced into this thing now that Powell's told us they're not going to be. Appreciate it, Michael, as always.